And could you break down for people who might be listening, because, one of the things we're talking about this seminar that we just did, IRA and 401K rescue, where we're talking about the fact that most people are going along out there, they're treating their IRAs or their 401Ks basically as savings accounts. They've got a piece of their paycheck that's going out every month. They're just adding money into these accounts, but they really don't understand what they're invested in. What kind of future do you think, what does the future hold for people who are investing in this manner?
It depends on how they're investing. And if people are buying mining stocks or buying precious metals in their retirement accounts, there's a good chance they'll come out okay. But people just blindly investing in the stock market now, if you look at the historical precedent, the stock market in Weimar Germany after World War I went up initially with inflation in Germany, but it didn't keep up. And then eventually it fell way behind.
Right. And so I guess the question is, a lot of people see all kinds of warning signs, red flags, on both the stock and the bond market. Can you break down why we're seeing those warning flags? What could happen and why?
Oh, gosh, the bond market right now, if you look at most municipalities, some of them have cut back pretty hard. Some of them are going after additional revenue without a thought of cutting back yet. A lot of municipalities have stepped up little things like cameras at the intersection to automatically write tickets. They've gotten desperate for additional revenue, but so many municipalities haven't gotten a cold, hard Monday morning slap in the face that they're going to have to cut spending.
Yeah.
And as a result, they're borrowing more to cover it, like it's a short-term deficit that they can just get a small bridge loan and bridge across it. But you're going to see more and more municipalities actually default.
Right. And this is why I've been screaming on this show for I don't know how long, to be careful if you've got your financial, advisor loading you up with muni bonds. I mean, those things are just kryptonite right now.
Oh, exactly. They're just guaranteed certificates of confiscation, I think is what Doug Casey calls them.
Yeah. And I mean, that's the thing with any kind of bonds right now, whether you're talking about muni bonds, corporate bonds, treasury bonds, even if these are bonds from the U.S. government. Essentially, when you are investing in bonds, people call those assets. They call them investments. They're loans. You're the lender, and you're likely to get stiffed.
That's right. It's a paper IOU.
Yeah.
That's all it is, and the IOU is only as good as the person who issued it.
So essentially what we can say then is that in good times, bonds can be a good deal, when the money is flowing and things are great. But in times like this, bonds are probably one of the most dangerous things you can invest in. What about stocks? Why are we seeing these warning signs with stocks? I mean, I'm personally seeing the CNBC articles talking about how these insiders are just bailing out left and right, selling their stock, which, by the way, we know that because they are legally bound by the SEC to report that. That's the only way that we know that they're doing it. It's not like they're having a press conference or anything about it, but we're seeing them get out of their own company stocks, and yet most people are just sitting on top of these stocks in their own 401Ks and IRAs.
Yeah, I think the old buy and hold is guaranteed, just a guaranteed mantra to get run over right now. You're just going to have to be a nimble trader right now, and as much as I hate to advise people to trade, you're going to have to be careful if you're in the market. You're going to have to run your stop losses up and just kind of watch things. But back to bonds. Bonds are going to default, but there's several ways that they can default. If you believe John Williams' inflation numbers of around 8% right now, say on a U.S. bond, which is, the top of the heap in bonds, the safest bond supposedly that you can get is a United States bond. If they're paying 2% and if the inflation is running 8%, they are currently defaulting on 6%. It is a slow death of 1,000 cuts default that's going on right now.
I see.
Now with muni bonds, municipality bonds, state bonds, you're going to have an outright default. They're going to adjust, they're going to push the payments further out, they're going to cut the interest down and pay back with dollars that are worth less than you loan them, or just finally outright default.
Okay, so yeah, just stay away from bonds is the moral of that whole story.
But the thing is, there are many forms of default. If they just don't pay you, that's what people think default means. But if they pay you back with dollars that are worth less than you loaned them, even though you're getting paid back, it's still a form of default.
That brings me to another question that I think is really important for you to answer here. People have got to stop thinking about everything in terms of how much money they've got, how many U.S. dollars they have, and instead it would be incredibly helpful if they start measuring it not in how many dollars I have, but in how many bags of groceries it represents, or in how many tanks of gas that it represents. That's a trend, I think, that people are going to start having that mind shift when it slaps them in the face later on, don't you think?
Oh, exactly. I mean, people measure things in dollars for a couple of reasons. Well, to begin with, you're taxed in dollars.
Right.
So, if you buy something that just keeps up with inflation, the government measuring it in dollars said you have a gain. Whereas you can say it'll only buy the same sack of groceries, but they're still calling it a gain. It's almost like we've got a rubber yardstick or a shrinking yardstick. People kind of can't wrap their heads around an inch is smaller today than it was yesterday. Mm-hmm. And people think of a dollar as a unit of measure. But it's a terrible unit of measure because it's flexible.
Right. It's a flexible yardstick, which makes it a worthless yardstick. And you need to find another yardstick, something real, something tangible.
That's right. If you were building a house and you're a carpenter, and every morning when you came and you went to measure things, they gave you a different tape measure that was different than the one you used yesterday, you'd have a heck of a time building the house, especially if it was shrinking every day, which is the general trend. Can you imagine what the house would look like at the end of the project?
That's a perfect example. So let me go back here for just a second with what we were talking about earlier, and this idea that people have of, you were talking about how if anybody's going to, financially survive with their IRAs and 401Ks, you're saying that they've got to have more of a trader mentality. Now, that's a tall order for a lot of people. They don't want to be traders. They don't want to mess with it. They don't want to have to think about it. In a case like that, when somebody does want to have something where their IRA or their 401k truly represents just a simple, safe savings plan, what do they do?
Well, for years, the default was just a money market account. I'll just put it in the money market account, collect simple interest, and I'll always have my money. And that's a killer idea right now, because it will kill your account.
Yeah.
Because you're losing about 8% a year in inflation that's eating away at it, and you might be gaining 0.5% in interest payments.
Which is a fancy way of saying that the amount of bags of groceries, the amount of light bills, the amount of tanks of gas that those dollars are going to pay for are going to be changing rapidly.
That's right. So if you do nothing, if you just put it in the money market default and you say, well, I'm going to get out of the market and I'm going to just put my money somewhere where it's safe, realize that you are losing. You are going backwards at that point.
Okay, so then you were saying, or you continuing along the lines of what you were saying, what do people do?
Well, unfortunately, it's kind of like your health. When you go to the doctor, you ought to go to the doctor because he's a coach. But so many people go to the doctor these days and they want to abdicate their own personal responsibility. Here I am, I'm sick, fix me. It doesn't work that way.
Yeah.
And it's the same thing if you go to your financial planner and just say, here's my money, take care of me, I don't want to think about it. That's not a smart thing to do.
Yeah. Oh, I'll tell you this story, by the way, just speaking along those lines. This happened to somebody in my family. They did the same thing. They had a financial planner. They turned the money over and they said, give me this yield. I just want to see yield, and you figure this out. Well, what that financial planner did is he sought out investments that paid him the highest commission. And there's one particular investment that this financial planner got my family member into. It was a REIT, a real estate investment trust. And as it turns out, we did a little, rooting around, looking into this thing. And I looked into it, and I found that this REIT had actually kind of sort of defaulted. In other words, the money is locked up and you can't pull it out. because, you know, it was a REIT that was primarily invested in high-end shopping centers, and God knows those are doing well now, Larry.
Oh, yeah. How'd you like to have all your money tied up in that?
How would you like to have your money tied into the people that are building the big, you know, fancy shopping malls where nobody can afford the stuff inside? Well, that's what this was. And so we're talking 30 grand gone.
I forget the Woody Allen movie. Somebody asked him what he did for a living. He goes, I'm an investment planner. I take care of other people's money until it's all gone.
Until it's all gone, yeah. And that's what's happening now. We laugh because it's sort of a horrified thing. It's like, you know, it's like the same black humor that, you know, ambulance drivers and undertakers start to develop after a while, because it's just that horrible. Jeez.
And I wish I could say there's just some simple thing, or send this guy your money and you'll be fine, or send that guy your money and you'll be fine. But there's no real substitute for just doing the work. Doing the work and investing your own money wisely and educating yourself.
That's not the answer I was expecting to hear from you, because what I was thinking you would say is, well, if you want to just have it, you know, sit on top of it and do nothing, then the safest place to put it right now is going to be gold and silver, particularly silver, no?
That's right, but even that is not that easy, because some people might say, well, if I want to buy silver, I'll just buy the ETF SLV.
Oh, yeah, that's bad.
And everything's taken care of now. But no, everything's not taken care of. Now, you may want to buy PSLV, which is the Sprott ETF, which is a more recent launch, but Sprott is a you know, in my opinion, a much more solid company than SLV, which I'm not going to knock the company that's actually put SLV out there, but I will say the depository trustee for SLV is J.P. Morgan.
Oh, boy.
Who coincidentally holds the largest silver short position in the history of the world.
It all comes full circle, doesn't it?
Yeah, so how would you like to have somebody who's absolutely desperate for silver because they have promised so much out at a cheap price, they absolutely don't know what to do? How would you like to have him hold one of the largest stashes of silver over here in his depository operation, and over here on the other hand, they're desperate for silver? So I can't say that J.P. Morgan might pull something underhanded, because that's not for me to say or not. But I'm just saying, you don't give an alcoholic a liquor warehouse to watch at night. You know, you don't hire an alcoholic as your night watchman at a liquor warehouse. It's just not a smart thing to do.
No, it's not. Well, you know, you did a great job on this video seminar that we've got available now at financialsurvivalradio.com. Again, it's called 401K and IRA Rescue: How to Safeguard Your Retirement Account from the Coming Economic Emergency. And you did a great job of kind of breaking it down step by step, how to do this, what to look for, what to look out for, you know, what to do and what to maybe avoid as people, you know, kind of navigate this new landscape. It's scary. It's a scary time right now, Larry.
Oh, certainly. And like I said before, one of my favorite things to tell new investors is, you know, even in good times, put about 10% of your total net worth in precious metals. In bad times, you may want to go to a heavier allocation of about 25%, but put 25% of your total net worth in precious metals, and every night pray to God that it becomes worthless.
Why would you do that? I'm just curious.
Because the other 75% is going to be smoking hot. The economy is going to be running at 110%, and you're going to be making money hand over fist in a good, healthy economy.
Well, and that being said, is that the bet that you're taking, or do you have a larger percentage of your net worth tied up in precious metals? You personally?
Me personally, I have a much larger percent. I'm probably in about the 30 to 35%, and that's my entire net worth. Now, I mean, I've got businesses and real estate ventures and all sorts of things, so I'm not talking about just my investment capital. I'm talking about my entire net worth. But you're taking that position because of what you see coming. I mean, this isn't just a blind bet that you're making here. Well, you know, when you're on the Titanic and everybody's dancing and the liquor's flowing and the party's going, nobody wants to get into the lifeboat, because the lifeboat's a coal lonely place out there, and that's what your gold and silver is. I mean, that's your financial lifeboat. Now, if the ship starts to sink, the lifeboat's looking pretty darn good at that point. But nobody wants to leave a wonderful, great investment economy and go get into the lifeboat. But if the ship's sinking, yeah, you got to. So nobody wants